Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Christopher Aaron of iGold Advisor. How you doing today, Christopher?
Darrell, doing well. Thank you. Thank you for having me.
Yes, so you were one of our speakers at the Vancouver Resource Investment Conference. I'm curious in your perspective on the sentiment, the energy, the excitement, the bullishness, the bearishness, all of it, right? What did you sense when you were there?
Yeah, I mean, this is now my sixth year at the VRIC. The first couple of years that I was there, gold was, 1,500, 1,600. It had been moving sideways for like 4 years. The sentiment was in the gutter. I mean, silver was $18 the first year that I was there. To compare that to today, where we had gold above 5,000 and silver above 100 when we were there, I know it's come back a little bit right now. Sentiment is good. If there's one thing that I can say, though, because I focus on the charts, both for the metals themselves and for a lot of the mining companies, the overall sector, these moves have been good. Don't get me wrong. In the last 10 years since I've been publishing at iGold Advisor, we've had gold move from 1,000 to 5,000. We've had silver move from 15 to 90. I mean, those are good moves. But when I look at the big picture macro charts, my data is telling me that these moves are actually just sort of in the acceleration phase, sort of somewhere around in the middle innings of these moves. I think there were a lot of people a few weeks ago kind of getting ready to call the end of these bull markets. I have a lot of data to show us that we are not at the end yet.
Okay, let's jump into some of that data. So what data are you looking at that shows that we are not at the end yet? I mean, obviously there's a lot of people that were like, should I have taken the profits? Some people did take some profits on some of the equities. Some people did sell some physical, I'm sure. So I'm curious, in what data are you looking at that shows that this is a longer term bull run?
Yeah, well, let's start with the most important chart. I'm going to do a screen share here. The single most important major macro signal that I'm paying attention to right now, I want to show you. This is from my VRIC talk 1 year ago, Darrell, January of 2025. And I brought up this chart, and I was showing this to people. This is the Dow Jones right here in green, and this is gold in the gold color, 10-year chart. And you can see, within a few percentage points over this 10-year period, 2016 through 2025, early 2025, the Dow and gold basically tracked each other one for one. Yes, there were a few periods of time here in which, gold outperformed, the Dow outperformed for a couple years, gold caught up. But net sum, just going back 1 year ago, we had a 10-year period nearly, in which the oldest stock market index in the developed world, the Dow Jones Industrial Average, and the 5,000-year store of wealth, the oldest store of wealth in humankind, were being functionally treated by the market as the same asset class. We were in this paradigm of buy everything or sell everything. Everything is one and the same. And just as a side note, I have some people, when I show this chart, say, why are you using the Dow? You should use the S&P 500 or the Wilshire 5000. They correlate with about a 98% positive correlation. And with the Dow, we have much more data to go back to in time. So what I was showing last year at my VRIC talk is that oldest stock market index in the U.S., oldest store of wealth, were being functionally treated as the same by the market over this 10-year period. We could argue that these are different, and I would say fundamentally these probably are different, but the market was saying we're in this paradigm where it's either buy everything or sell everything. We're going to consider everything the same, okay? So that was 1 year ago, okay? Now I want to show my chart from this year, and this is where things start to get really interesting. Do you see this one? Mm-hmm. And so notice here, I mean, all we're doing is fast forwarding 1 year. The last chart ended right here, January of 2025. Notice the divide that has grown now between gold and the Dow over just the last calendar year. So we've seen a radical split in this behavior. And what we could argue is that for the first time in 10 years, the market is actually saying, because if we go back to the previous 10 years before this split happened, basically the market was saying, yes, we know there are problems with fiat currency. Yes, we know there are problems with debt in the United States and around the world. But there's actual progress going on in the general economy as well. There's technology, there's AI, there's medical technology, et cetera, et cetera. And the market did not know which of those was going to be more important for the last 10 years. That's why they were both moving together. Well, the market has finally given us a signal of which is going to be more important, let's say over the next several years, intermediate term. I'm sort of looking out to the end of this decade, very beginning of the 2030s. So if investors can see this, this should be really clear. We had that positive correlation for almost 10 years, and now this major split. So what I want to do now is put that into more of a historical perspective. And all we're going to do is look at that exact same relationship, Dow versus gold, but now we're looking at it for 130 years, not 10 years. And now we are looking at it as far as a ratio. So it's not two separate lines, one line to show gold and one line to show the Dow. Now it's plotting the Dow versus gold in a ratio. Mm-hmm. And we've got this key here, the higher that this goes, the better that the Dow Jones is doing. The lower that this goes, the better that gold is doing. And remember that split that I showed in the last chart where we saw gold and gold radically outpacing the Dow. That is visible right here by what I'm labeling as the fourth turning. The fourth turning of this ratio downward. And remember, downward is in favor of gold. You've got to, if you're trying to think about this, is it good or bad for gold? You got to remember, the lower this goes, the more gold is worth. Mm-hmm. So we are seeing that break. You saw it on the last chart, and this is the way that you can see it on the ratio chart. And if we just go back, and the point that I made in Vancouver that I really want to emphasize here for anyone who did not see that talk or who is sort of new to this sector, this signal only appears every 30 to 40 years throughout history. And this signal has only appeared 3 other times in all of the available data for the Dow versus gold. I'm not cherry picking time periods here. This is it. The Dow Jones goes back to 1897. So when we look at the 3 other turnings of this signal here, you look at the turning that happened in 1929, which led to the Great Depression and then World War II, in which the Dow fell by 90% versus gold in 3 years. And by the way, if one thing falls by 90%, if you were to flip that on its head, it means the other thing outperforms by 1,000%. That's simply how the ratio math works. So you look at the cycle that happened after the Roaring '20s into the Great Depression, right? 90% down for the Dow versus gold, or 1,000% higher for gold versus the Dow. You look at the second turning that happened here in 1966 in the guns and butter era, the Vietnam War, a lot of social spending, basically the prelude to the abandonment of the Bretton Woods Accord, the abandonment of gold being tied to the US dollar, which happened in 1971. But this was the prelude to that. The market was showing us ahead of time that something here was going to happen. 96% decline for the Dow versus gold in 14 years. We had the recovery in the 1980s. We had the PC revolution. We had cell phones, CD players, internet. You have the NASDAQ bubble up here at the third turning. This was sort of a shortened cycle. It was only 10 years long, kind of a mini cycle, but still 86% decline for the Dow versus gold in 10 years. So what I'm saying here, Darrell, is that when we look at this signal appearing now again, and again, we saw it in the last chart, the split between gold and the Dow. When we look at this signal here, the fourth time that this signal has appeared, you can see it by the blue trend break. If we just take the average of the previous 3 cycles, the only 3 cycles, and we apply that to the current cycle, it tells us again that the Dow is going to be losing 90% of its value in 9 years. That's the average of the previous 3 cycles compared to gold. Now, investors might be wondering, okay, so where does that put us in terms of gold? Can we put a gold price on that? If the Dow is going to be losing 90% relative to gold, or the other way we could say it is, over the net sum of this decline, gold will be rising 1,000%, but it could be somewhere in between, right? It could be the Dow losing some value, gold gaining some value. This is a relative chart. I just want to tell you that the historical average, see this 2.2 that I have right up here in yellow? Mm-hmm. The historical average, that 90%, will bring the ratio to 2.2, okay? 2.2. Think about this for a moment. The Dow is at 50,000. If this ratio does what it's done each of the other 3 times and it gets to 2.2, that implies gold above 20,000 US dollars per ounce for this cycle. Okay, you take 50,000 and you divide it by 2.2. You're going to be at about 22, 23,000. And people are going to say that I'm crazy, that this can never happen. I'm showing you the data right here. We saw it before on the split between the ratio. And so, we're looking at gold above $5,000 now. We're looking at silver above 90. There's a lot of investors who are, I would say, more casual investors who are maybe only following the headlines. I'm not talking about anyone listening to this podcast, because if you're listening to this, you're obviously getting informed and dedicated into this sector. Mm-hmm. But I see a lot of casual investors in this sector coming out over the last month or two saying, that's it, this move is over. I can't predict the future to 100%. I never said that I could, but I am a strict student of visible data and historical cycles. And I'm telling you, all of the visible data, all the historical cycles tell us that this move is nowhere near over, and it would not be out of line with the historical averages for gold to get above $20,000 here within the next number of years in this cycle.
Okay, got it.
Our project is right in the southeastern corner of Wyoming. In the space of 4 years, fully engineered, fully permitted.
The ASIC is what caught my eye, $937 per ounce.
110,000 ounces per annum. First year of production is the most impressive. 132,000 ounces of gold, 24 million pounds of copper. You really want these things front-end loaded like that. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
Okay, so just thinking about it on a kind of macro history scale. So that first turning, obviously, you had a global bust, depression, gold's confiscated. It's a floor set for the price of gold and such, and then you have these multiple years in between until you have the second turning where Nixon then eventually takes the gold off close the gold window. Gold rallies significantly. And then you get Volcker coming in with 20% interest rates, and then many countries ran into U.S. treasuries and U.S. bonds, right, getting a significant yield on those treasuries. And we went through a bond bull market. And then you begin to see where the dot-com bubble peaks on that third turning and then rolls over. And then it made a lower high where we're currently on the fourth turning now. And so now we see that rolling over. And right now it's rolling over with, debt to GDP in the United States, a significantly higher debt and deficit, significantly higher. There's no way they're going to be able to get interest rates up to 20% to fuel another bond bull market. and such, and now you have so many other factors like geopolitical risk, central banks buying. It's so many other factors, and so like I could definitely see this ratio coming down significantly.
Yeah, exactly right. The debt to GDP right now in the United States is higher than it was in World War II. I think investors really need to take a step back and ask themselves how and why has the debt gotten so high? I mean, it would be one thing if we had just spent 6 or 7 years fighting off the Nazi or the Axis powers, and we had to rack up that debt, but we haven't. I mean, what the heck is going on?
Yeah, for sure. Yeah, it's this is where we get into politics and constituencies, and no one's willing to take the pay cut, man.
It's exactly right. And I mean, we could even look bigger picture and ask ourselves, you look at the way that politicians on each side of the spectrum are behaving, maybe with the exception of some of the libertarians, but those, that party is not really considered a main party these days.
We're just
it doesn't matter.
We're just a nuisance.
I know, exactly. But you look at whether it's Republicans or Democrats, right or left. I mean, they say one thing, and then as soon as they get into office, it's just let's spend as much money as possible. Let's just whoever votes for us, let's give them as much money with the printing press. And I mean, it does lead one to wonder: is this form of government sustainable over the long run, or does this eventually lead to some sort of collapse and reset? I mean, perhaps that's a topic for another day. But I mean, over the short and the intermediate run, it's clear that what individuals need to do is protect themselves financially, be as healthy as possible, be as sovereign as possible, have your own land, have your own house, try to get everything paid off, get out of debt, and then really build up your diversified portfolio to protect yourself.
Yeah, for sure. Yeah, definitely got to focus on your own household, especially, and can't rely on the government to do it for you. So when we're looking at like this chart, I think at one point the Dow-to-gold ratio was like 1-to-1 at some point. So I'm curious so I was talking with Peter Schiff, and Peter Schiff was like, yeah, if the Dow-to-gold ratio goes to 1-to-1, he's like, I'll buy the Dow. And so I was like, okay, that's interesting take. So I'm curious if you think that at some point the gold ratio goes higher again, or do you think we're in a structurally changed environment to where, it won't recover or whatnot? I'm not sure. I'm just curious. Your thoughts on it.
I mean, so you're talking, could it go below, let's say 2.2 and go down to even 1-to-1 or something like that?
Yeah, and then recover.
Yeah.
I don't think it's going to recover to the 2000 highs, but like if someone were to see such a massive opportunity in the Dow Jones and say like, hey, I could sell an ounce of gold for one share of the Dow, some people may take that trade. And so I'm kind of wondering your thoughts on, do you think this is like we're dealing with something structurally different? Because some may argue that we're in a monetary order reset and such, and so things are going to change significantly, and we can't rely on the patterns of the Dow going higher again. Or some people may say like, oh, that's a bargain. I'm going to bet that the Dow goes higher at some point. And so just curious in your thoughts there.
Yeah, I think that's a great question. And so now we're looking like one major step ahead. And I've done the analysis. I like this because now we can start thinking about the next cycle, for example. I've put this green line up here. Can you see this?
Yeah.
And I've just done that to make it really obvious. And what I want to show I want to show the investors how if we start looking at, let's say, the bottom of that Great Depression cycle, 1932. Great Depression, gold revalued from $20 to $35, gold outlawed to own, and then we take that and we sort of connect it here with the low of the 1980 cycle. Whether we want to look at the absolute low, whether we want to look at sort of a best fit of the lows in here that formed, and that was the 1-to-1. That was the 1-to-1 level in 1980, when gold hit 850 per ounce and the Dow hit 850 points basically in the same calendar month. If we were to sort of extend that, maybe do a best fit, between the absolute low and the best fit low, sort of like this. And the point that I'm trying to make is whether we draw it like that or like that. Notice that the lows are coming down. From the Great Depression low, that hit a value of about 2-to-1 over there. Mm-hmm. But the low over here in 1980 was closer to 1-to-1, as we just talked about. And so you could argue that the lows are actually coming down, and that what's due to happen in this cycle, it would be off the chart. You can see this here, right? It would be off the chart. But you can make the case that what is due to occur here over the coming years is actually a lower low. I'm talking below 1-to-1, sort of like off the chart out here, that would be the next stage of the cycle. And then if we were to look at the upper boundary here, notice that the first turning, the second turning, and the third turning are getting higher and higher in time. Can you see clearly second turning is higher than the first, third is higher than the second? Mm-hmm. I can argue here that the Dow-to-gold ratio is in a series of giant waves that are getting more and more extreme every 1 to 2 generations. We would call this an expanding megaphone pattern. It sort of looks like that, you would hold a megaphone if you're trying to broadcast your voice out. It's these volatile patterns that get higher and lower and higher and lower throughout time. I think the present cycle that we are in right now, whether I look at the break of this is a 45-year trend, this dark blue. Mm-hmm. The break of that, which implies a target down here, 2.2, it could even come to 1. Yes, I'm open to that. Maybe even below 1. And so investors really need to think about what that means. I mean, if the last cycle in 1980 got to 1-to-1, and the debt is worse now than it was in 1980, 1-to-1 would imply $50,000 per ounce on gold. Mm-hmm. I mean, it's crazy to think about, but that is what happened in the year 1980. So all we're doing is looking at these historical cycles. And then I would say, to get back to your original question, we fast forward a few years, let's say early to mid 2030s, after we come down here into the range of 2-to-1 or 1-to-1 even. Then I think the debt will have been mostly cleared from the system. A lot of that debt will have been defaulted on or printed away. I think there will be potentially even the possibility of a reset in the gold price, maybe even an official backing to some extent of the currency system by gold. I think once that all gets sorted out, it's going to be at much higher gold prices. But I do think then, yes, we get into the 2030s. I think that's when you sell all your gold, or most of your gold, most of your silver, most of your mining companies, and you move it into Dow and technology stocks, because when we get into the bottom here around 1 or 2-to-1, that is, historically speaking, the time when then you set up for a major bottom and then the Dow starts outperforming.
Yeah. Okay. Got it. So when we're thinking about the Dow measured in gold, right? So when we look at, the Dow's measured in real money on this chart. And so obviously, when this trend reverses after, the bull market is complete and, we get a new gold price, and the gold price may be, 30,000, 40,000, whatever the case may be. And then let's say we do get a reversal in this chart. I'm kind of wondering, and my thoughts would be like, we won't hit another high. We may hit a high measured in dollars, but we won't hit another high measured in gold. So like if we look at, the 2000s bull cycle where it reached the top, the highest peak, that was measured in gold, and I just don't foresee it like getting back to that point anymore.
Yeah, I mean, it may not. It may be sort of a muted cycle. I would say, though, after we get into this range of 2.2, maybe 1, maybe even below 1, we're talking early to mid 2030s on a highest probability, I would still say that's probably the point where you, aside from, let's say, an emergency savings account, that's probably the point where you start swapping out precious metals related assets for industrial and technological assets, even if that cycle doesn't get back above, the previous peak around 44. Even if it were to move from, let's say, 1 to 10, you're still talking about a 1,000% gain in the Dow versus gold at that point. But the good thing is that with that, we're talking like 2 major steps forward. Mm-hmm. I want to come back to this. We right now are, and we can have that discussion, right, in the next several years. I hope that we're still talking and
for sure,
discussing these things. There is such a wealth producing period of time ahead of us still for precious metals investors that I want to emphasize that. I don't want to get too far ahead of ourselves here, because if I'm anywhere in the vicinity of being correct, like anywhere on the right planet where this is going to trend down to 2 to 1 or maybe 1 to 1, I mean, we're talking gold still several orders of magnitude above where it is today. And then we're talking silver in the well into the mid triple digits by that point as well. And if I can show 1 or 2 more charts here, back to the original point that we were talking about, why do I think that this cycle is not over yet? Let me show this is really interesting here. A 45-year chart. We are looking at the gold miners relative to the U.S. stock market. Gold miners to the S&P 500. It's a simple ratio. This chart goes back to the early 1980s. I wish this is the XAU index. The XAU is sort of the historical version of the GDX. It's like a large cap gold miners fund, about 20 of the largest gold mining companies in the world. And so it's similar to the GDX. With this XAU, though, it is the longest dated gold mining index that we have in modern history. It only goes back to 1984. So unfortunately, we don't have data going back to the actual peak in the year 1980. But even going just back to 1984, which we know was already lower than the 1980 peak, if you look at where this ratio hit, the ratio actually got close to 1 to 1 for the XAU index versus the S&P 500. Right now, look at where we are. We're still all the way down here. I mean, this ratio is below 0.07. You can see to talk about more recent history, the 2011 peak in the gold miners versus the S&P 500. Look at the 2011 peak right here that I have in yellow. I mean, at that point, it hit 0.2. To get from where it is right now below 0.07 just to get back to the 2011 peak implies a tripling in the average gold miner with no change in the stock market from where it is today. So that's just to get back to the 2011 peak. So, and then if I want to talk about getting back to the 1980 peak, I mean, we're talking about a 1,300% gain on average. And obviously this could happen with the stock market itself falling, at the same time as the gold miners are rising. I'm open to that scenario. But just to get back to the question that we started this interview off with, why am I so sure that those sort of late coming investors who were just looking at the bullish momentum, let's say a few months ago, and saying that's it, gold has gone too far, silver has gone too far, the miners have gone too far. Yeah, I mean, over the short run, those were quite powerful moves. Nothing moves in a straight line forever. We did see significant short-term pullbacks in the metals a couple months ago. But over the long run, we're nowhere near the levels that would coincide with long-term, talking multi-decade or generational type peaks. We're nowhere near that point.
Okay, got it. Yeah, that's a really good chart, the XAU to S&P 500 ratio. So I'd love to get your outlook on silver and what data are you looking at regarding silver and where that's headed?
Silver, let us just remember, has just broken out of a 45-year consolidation. This is the critical piece to really remember. And recall how when we were looking at that relationship of the Dow versus gold, the Dow-to-gold ratio, we talked about that solid blue trend. That was a 45-year trend that had just broken. It's no coincidence that 45-year trend broke in favor of gold basically at the same time as silver broke upward from its 45-year consolidation. So just as a backdrop, in case investors are new, remember silver hit $50 per ounce in 1980. That's when the Hunt brothers cornered the market briefly, but it did hit $50 per ounce. Then in 2011, so 31 years later, silver got back to that same point, $50 per ounce. I was participating back then, 2010, 2011. I know how that went. Fast forward to November, end of November, I mean literally 3 months ago is when silver exceeded that $50 per ounce level. Mm-hmm. Now there's a phrase in price analysis, technical analysis as they call it, which is the longer the base, the stronger the move. Or some people say it, the longer the base, the higher in space that a market can go. And there's a reason for that. The reason for that is because all this metal is being accumulated all this time, every year, every decade. All this metal is being transferred from weak hands to strong hands every in each cycle. And you have 45 years of this accumulation, and the market finally breaks higher, right? So what I would say here is the idea that after 45 years of a breakout, that 3 months after that breakout, that silver is done, that's going to be it. I mean, that would fly in the face of every historical cycle that I have studied, whether we're talking about what happened when gold broke its 1980 peak, copper, oil, platinum, palladium. You know, we look at all these other commodities when they finally broke their 1980 peaks, they had several years worth of gains after that point. And those gains typically featured several hundred percentage points on the way higher. Not just a double and not just over 2 or 3 months like we've seen for silver. So I am looking at silver in this cycle. I want to talk about the next 12 to 18 months. I'm looking at silver getting into the $200 to $300 range for this cycle. I think that's going to coincide with gold in the vicinity of 8 to 10,000. So notice these are not my final long-term targets. These are sort of my intermediate-term targets. Silver in the $200 to $300 range, gold 8 to 10,000, depending on the twists and turns of the markets. I think at that point we're probably going to have the first significant correction in the precious metals that we've had in a couple years. Long-term, beyond that, can silver get into, let's say, the mid-triple digits? I mean, if gold's going to go to 20,000, like the Dow-to-gold would project, then you better believe silver is going at least into the mid-triple digits. But for that, we're talking about after this immediate move, probably a significant pullback, and then that final wave sometime in the 2030s.
Okay, got it. Okay, what's your thoughts on other metals in this particular sector? I mean, we have the platinum group metals, you got the base metals and such. Just curious, and what's your thoughts on those?
I like, in this cycle right now especially, I like palladium. Because if you think about the 4 major precious metals, if you think about gold, silver, platinum, palladium, the 4 I mean, I know there's rhodium and some smaller precious metals on the periodic table, but if you think about the 4 major precious metals, 3 of those hit a new all-time high within the last 2 months. That was gold, silver, and platinum. There is one that has not yet hit a new all-time high, and that is palladium. The previous peak for palladium was about 3,300. It's currently trading at 1750, close to 1,800 today. So we're talking the one outlier would need to nearly double to get back to its all-time high, whereas the other three precious metals, not only are they at all-time highs, but they're in this phrase that we would call blue sky territory, where there's literally no one who knows how high these things are going to go. I mean, they're making new all-time highs every month, every week. That's a very powerful situation for a catch-up move in the sole laggard, which is palladium at this point.
Yeah, because I mean, silver was a laggard at one point, and it finally broke out, and broke its all-time highs and such. And not saying that silver and palladium, their bull cases are the same, but you could see that. So, looking at metals like palladium and such, I mean, you have physical palladium, you have some of the equities. I mean, I think you got like Paul, which is one of the physical trusts. I mean, you got like the Sprott physical trust. You don't really got a lot of miners that focus on those metals. I mean, I think platinum and maybe some palladium come out of South Africa. You get some out of Russia, maybe a little bit out of Canada. So what are kind of some ways that you're playing the palladium space with your conviction?
Yeah, specifically, what I'm looking at is, I mean, physical palladium is fine if you want to buy coins or bars, but that's got to be a real long-term hold, because the premiums on those that you'll face in each direction don't make it suitable for short-term trades. I like the Sprott. Sprott funds are good for long-term holds. There's the I think it's by Aberdeen is the ETF that tracks palladium. It's the ticker is PALL. Yep.
Yeah, Paul. I just called it Paul. Oh, the Paul, whatever.
Yeah. The PAL is a good trading vehicle for that. We're currently in a palladium trade. I think over the rest of this year, I'm not sure that it's going to quite get to a new all-time high yet, but I'm looking at the region around 24 to 2,500 for palladium. So I think the PAL is a good vehicle for that.
Got it. Okay. Do you think platinum has more room to run with your outlook on gold and silver? I mean, platinum was at one point was more expensive than gold, and I mean it's more used in industry and cars and things of that nature. But I remember when rap stars used to come out with the platinum chains and the platinum teeth, and everything. And so like it was a hot thing for a while, and then gold has obviously surpassed that since. So just curious if you think that platinum will flip gold again as far as on the price standpoint.
Yeah, that's a really interesting question. I mean, I remember that as well from so many years ago. Platinum was always more than gold, and I remember in the crash of 2008 was the first time in the modern cycle that platinum fell below gold briefly. And I remember saying to myself back then, man, if that ever happens again, you just load up the boat on platinum, because it was the first time that I had ever seen that. And then, you fast forward a decade and platinum is below gold for 10 years and running. Good news for platinum is that it is in the process of breaking out to new all-time highs as we were speaking. Platinum closed at 2365. The former all-time high was 2300. That was from 2008. So you're looking at like an 18-year breakout that is happening for platinum right now as we are speaking. I would have a measured target for platinum just based on, again, similar to silver, like how much energy has been consolidated, has been gathered in that basing process over the last 18 years. If I look at the depth of that base, platinum bottomed around 700, and you've got 2,300 for the previous all-time high. So you're looking at about, you're looking at a 1,600 amplitude of energy that is built up there. You add that onto the breakout point in price analysis, because that's how much energy has been built up in that consolidation. I would be looking at platinum getting to close to $4,000 per ounce as a measured target on a trading standpoint here over the next handful of years.
Okay. Okay, got it. That's good to know that there's still some opportunity there, because I know from November, I think it was November till the end of December, platinum ran up about $1,000, and that was like a violent move upwards. And so, yeah, definitely good to know opportunity is still there. So, Christopher, connect the audience with where they can connect with you, connect with your research. I mean, you're obviously putting out a lot of work on iGold Advisor. I know you're many different places. You're putting out videos and such. And so where can people connect with you?
Yeah, thanks, Darrell. And just to give investors the philosophy behind the type of work that I do, and the reason for this is that I began investing, as I said in the introduction, I began investing right before the crash of 2008. That's when I was learning about precious metals. And I was listening to a lot of the well-known investors who are still around today talking about the problems in the global economy before the crash of 2008. And they were saying, therefore, you should buy precious metals to protect yourself. What happened in the crash of 2008? The Dow Jones, the stock market, fell by 55%. Silver fell by 60%. It fell by more than the stock market. And the gold and silver miners fell by 90%, 90% in 6 months. And so I was like listening to, I'm not going to mention any names here, but you guys know who I'm talking about. A lot of these people are still around today. They were talking about all these reasons why you should own precious metals. And I was listening to them. And next thing you know, I'm down 90% on some of my gold miners. So I said to myself, there's got to be another way of evaluating these markets. And so the way that I've gravitated toward is to focus on price, the single data point of the price of the assets. We can have all the cocktail party conversations that we want about, what's going on big picture, and those things are important to understand. But ultimately, if investors take a look inside and ask themselves, what really matters to me? It's the price. What is the price of the thing going to do, right? So my analysis at iGold Advisor, what we offer is price analysis of the precious metals, of the commodities, of the mining sector, individual miners. It's focused on price. I understand the fundamentals, but we focus on price for the reasons that I described, because it's proven to be the only way to stay on the right side of the market over all these cycles, for me anyway. iGoldadvisor.com, and on X, I post for free at iGlobalGold on Twitter or X.
Okay, got it. And just one last little note on price. I mean, price is important. It's important to understand the difference between price and value. And so, like, when you're getting into some of these mining equities, if you have a valuation method of like, okay, I think the company is valued at this, and the price may exceed that value that you assign to that particular equity. And so that's how, some of the best in the game make their profits. They take the profits off the table. Okay, the price has exceeded my target, right? And so you have to focus on price at some point, especially when you understand value as well. So I appreciate you sharing that.
I couldn't have said it any better, and that's on the upside. And I would also tell investors that lesson applies on the protective side or on the downside. If you have a lot of stories, if you've been listening to a lot of people tell you stories, let's say about a specific mining company, and maybe they're moving into production or they're supposed to have the next big deposit somewhere, right? And that story sounds really good. You've got to be really careful about getting married to a story. Because if the story says one thing, the story says higher, but the stock is drifting lower, it's telling you something. It's telling you that someone knows something that you don't know. And that person is selling despite the story that is circulating out there. And I've learned the hard way, if we do not pay attention to the price, what is actually happening. So as you described, Darrell, on the way higher, absolutely, but also on the way lower. If we don't pay attention to the price, we can get really blindsided by the markets.
Yeah, agreed. All right. Well, Christopher, appreciate you coming on the show. You all be sure to go check out iGoldadvisor.com. Also hit the subscribe button if you haven't subscribed yet. Let it have your support. Thank you, Christopher.
Thank you very much, Darrell.